it's a new lens for me this last couple of days, Caitlin, because in the UK, we have something similar to the FDIC, and our bank deposits are covered up to about £80,000. I never have £80,000 in the bank. Why would you? It's melting away.
But
I never do. Yeah, put it in Bitcoin, you put it in housing, you put it in gold, you put it in whatever, anything else which can either, that appreciates in value or can earn you some kind of interest. But I don't have that. But in terms of my business, I do, because I have
of course,
seven full-time employees, and you know how cash flow works. I've always got to be 3, 4, 5 months in advance.
Yes.
I've now just seen a situation where there is a run on a bank, and there are people, owners of businesses, who are saying, I'm not sure I can make payroll this week.
Correct.
That is a situation that could affect me. Yeah, if there was a run on my bank, I could be in a situation where I can't make payroll. And now I'm like, well, do I need to have, I don't know, 10 corporate accounts, each with up to £80,000 in? Do I need to do that?
Yes.
Is that what I need to do?
Yes. So there are a lot of people. I'm sympathetic. Like the CEO whose interview I heard this morning, the $25 million biotech corporate cash sitting uninsured in Silicon Valley's account. 250,000 of the 25 million in his case was insured. That's it. Okay. Now, here's the thing. The whoever runs finances at that company should have been paying attention to this. I spent a lot of time with the corporate treasurers when I was working at Morgan Stanley, working with corporate treasurers, understanding the pain points of corporate treasury. The big companies, right? General Electric has 10,000 bank accounts around the world. They probably have 1,000 people in their corporate treasury staff whose job it is to reconcile all those things, to move the cash around. But here's the thing. Those treasury analysts are also understanding the counterparty risk of their banks, because they understand that only $250,000 of their bank deposit is insured. Now, one of the interesting questions is, should that CEO of the biotech company have had his finance person analyzing the counterparty credit risk of Silicon Valley Bank? Yes. So when he said, "Oh, that money's mine," that's the way it should be, but that's not the way it is. He should have had his finance person analyzing that. One big lesson for every business, yourself, as a small business owner, all the way up to, the GEs of the world that have 10,000 accounts. Everybody needs to understand your bank, you're lending money to your bank, and your bank might default on you. And you need to understand the impact of that. So what does it mean? Should you go get 10 different bank accounts? I'm not going to give advice for that in particular, but I remember back in 2008, that is exactly what everyone around me at Morgan Stanley went out and did. They ran out and opened a bunch of bank accounts and put $250,000 in each of them just to spread it around. It is that is what rational people who understand this risk might do. Or alternatively, a sweep account where you take up anything above the $250,000 and put it into U.S. Treasuries. I'm sure something like that works in the UK as well. Yeah,
but so Caitlin, if I wanted to use something like a custodia, what kind of rates would you charge to custody the money? God, it sounds like an advert. Give me an advert, but show me. What would it be?
We're not operating.
But if you were, is it something that may be like a 1% of your deposits that would cover your?
Much higher? No. It won't be that high. So I got to be really careful here. But
okay.
But it also all depends, right? Because if all you're going to do is deposit your money and just have it sit there. So here's the way the math works. For a bank that does nothing other than, the narrow bank's business model, they would have to hold 5% capital after their first 3 years of operating, which they have to hold 8% capital. Okay. So you've seen the Custodia propose to hold 108 cents for every dollar in our Fed master account. That extra 8 cents was our shareholders' capital during the first 3 years. And in the following, thereafter, it would be 5%. That would be the requirement. Okay. So that's the basic business model. So the customer has to basically cover the bank's cost of capital. Otherwise, the bank loses money on the relationship. The other way to handle that is to say, all right, it's the way the big banks handle it, to look at the customer holistically and say, all right, if this customer is also depositing Bitcoin for custody and they're just using the US dollar piece as an ancillary product, that ancillary product has to cover its costs. It has to stand on its own. But this is one of the reasons why it's so important for banks not to be the narrow bank. And again, the Wyoming Speedy Banks cannot, by law, just take customer deposits and turn around and pay interest on them and basically be a pass-through to the Fed. They have to provide other services. If you look at Custodia's business model, it's Bitcoin custody. If you look at Kraken's business model, Kraken Bank, they were going to provide debit card services. They were going to provide custody services. They were going to provide prime services, as Custodia planned to provide as well. So there are a whole bunch of services around digital assets that diversify the product exposure. Now, come back to the question: how do these banks make money? It should be pretty obvious. It's the same way that Bank of New York or State Street or Northern Trust make money. It's mostly on their services, mostly in their cases, custody. Those banks don't make money off spread. They make money off fees. Big difference. And it's a successful business model.
But I don't need to buy custody service of Bitcoin. I'm a Bitcoin. I know how to self-custody.
Understood.
I've got my CASA multi-sig. But right now, if you turn around to me and said, look, you can take your 80,000 pounds insurance risk, or you could pay like 1%. I would pay 1% of my, I would happily pay for custody of my pounds in my bank account for my business, knowing it was 100% backed, because I cannot have the risk that I cannot make payroll.
Right. Because that's catastrophic for you, of course. Yeah. And so what's interesting is that the Fed has blocked you from having that choice, were you a U.S. company, by prohibiting the Wyoming Speedy Banks from getting access to Fed master accounts. It is far from over yet. We're in a big fight. And it's going to take some time, but I didn't walk into this anticipating that fight was how this was going to end. I didn't want to be here. Our board didn't want to be here. However, it's where the Fed has forced us, and here we are. And we are fighting like hell.
Well, why is the Fed doing this, though? Look, I saw in the Lynn Alden article, she said the reason that they're against this is because if you have a full reserve bank, that will suck up the liquidity from the rest of the sector, because everyone would put their money there.
I don't think so, and I'll tell you why. Because because Custodia, our business plan was not to pay interest on deposits at all. And the traditional banks can pay interest on deposits. How? They can afford to, because they're making money on loans. So they share some of that profits with the customers by paying interest. And my reaction to that argument, which we heard at the Wyoming legislature before the charter got enacted in Wyoming back in 2018, my response was, if the traditional banks are so afraid of competition from a bank that's not going to be paying interest, then you really shouldn't be coddled by the regulation. Let competition happen. Let people choose whether the certainty of keeping a deposit in a full reserve bank is worth it to them relative to the interest rate that they could be using by lending their deposit to a bank that pays them interest. It's a simple calculation, and not everybody's going to make the same decision. Markets work.
Well, so is there a problem here that the big banks are not independent enough from the Fed?
Well, of course they're not independent from the Fed.
Not independent enough. Is that one of the issues? Should there be a line drawn between the Fed and the banks and complete independence?
Well, you can't, and I'll tell you why. If you go back in the history of the Fed, and by the way, all central banks work this way. Not all of them, but most of them. The banks themselves are owned. The regional Federal Reserve banks are owned by the banks. They're quasi-private entities, although they do when they do administrative functions. There is definitely ambiguity, and they like to claim that they're private entities when they want to claim they're private entities, and they like to say, no, we're doing government functions when it's in their interest, right? And there's a hot potato back and forth where they pass hey, we're public, no, we're really private, okay? But ownership-wise, it is true that they are owned by the banks. The way the Fed works is there's a government agency that sits on top, the Federal Reserve Board of Governors, that is subject to all the government agency requirements. And then the 12 regional Federal Reserve banks are legally owned by banks. They are legally owned as private institutions by their members. Okay, so you cannot segregate the two. because the shares of the regional Federal Reserve banks, which is where the balance sheets of the Fed are, people talk about the Fed's balance sheet. It's actually an amalgamation of the 12 regional Federal Reserve banks' balance sheets. Those entities historically were formed by private commercial banks. And then, of course, when the Fed was formed in 1913, they basically created what is effectively what became ultimately the Board of Governors, which is a federal agency. And it was, again, this, the creature from Jekyll Island. It was, it was a kind of a corrupt bargain. It was more than it was a corrupt bargain back in 2013 during, ironically, the progressive era. So what's interesting is you now have progressives that have in the United States attained positions of real power. You asked earlier about Bernie Sanders versus Elizabeth Warren. They're both progressives.
Bernie Frank's versus Elizabeth Warren.
Barney Frank. Well, Barney Frank was on the board of Signature. Elizabeth Warren is the progressive senator who the progressives really tried to nationalize banking back then. And I do think that there's a real push to try to nationalize banking right now. And we know a lot. And there's a lot, like I've hinted, there's a lot that's going to come out about the Custodia situation that is going to stun people about exactly how much coordination and politicization of a lawful applicant to a federal agency occurred. And like I said, at this point, we are fighting. Something untoward happened to Custodia. And in fact, I'm making a trip to Washington, D.C. because Congress wants to know exactly what happened to Custodia. And we do have evidence. And I'm going to be sharing all that evidence.
Well, I'm pretty sure Cynthia Lummis will be very interested in what you're doing and probably has your back. And I would have thought there's a few other senators out there who probably have got your back in terms of this. And look, I want to know, I'm sure you'll come and tell me at the time you can tell me. I'm conscious of our time. We've got 9 minutes. I do want to cover 2 subjects so we can finish out. Very quickly, I just want to cover Signature because it seems like the FDIC took over them whilst they were still solvent. So very quickly touch on that, and then let's talk about QE to infinity.
Well, so Barney Frank, who's on the board of Signature, again, Frank of Dodd-Frank, the Wall Street Reform Act that happened right after the financial crisis of 2008, 15 years ago. He did tell both CNBC and Bloomberg yesterday. I saw 2 different interviews quoting him as saying, this was a solvent bank. Yes, there were big withdrawals on Friday, but this was a solvent bank. Had we opened on Monday, we would have been a going concern. That is a staggering statement. And it does, there have been shareholders who have come out and said something untoward happened here. Notice the theme? Because Custodia had the same thing happen to us, a politicization, and it was designed as part of a coordinated hit between the White House, the Federal Reserve, the FDIC in their case, and Congress on a bank that was favorable to the digital asset industry. And so this is going to be interesting because the truth will be told. Okay, the facts ultimately will come out. This is why an independent investigation needs to happen, and Congress needs to take this on. This is why, again, when Elizabeth Warren said she didn't think the Fed should be investigating itself, she's right. She wanted she didn't want Jay Powell to be leading the investigation. She wanted someone else at the Fed. Again, I'm back saying, no, a bipartisan coalition needs to look into this. The Government Accountability Office, the GAO in the United States, needs to look into this. There were some corrupt things that happened here in the move against the digital asset industry, and in particular against the digital asset banks. I've said this before. Federal agencies have far outreached their statutory authority. How do you deal with that? The Government Accountability Office can look into it. Congress can look into it. Reporters can and will and are looking into it. And then, of course, you've got the judicial branch, which is an equal branch of government where litigation is a remedy for agency overstepping. And we have seen it. Now, what's interesting in Signature's case is that it does look like the state banking authority, New York in their case, stepped in before the FDIC did. And it's come out that the FDIC was surprised that they were handed Signature Bank on Sunday because they didn't think that it was a bank that would have normally gone into receivership. When the FDIC takes over a bank, they typically bring their examiners in at 5 p.m. and then essentially receive the bank and have it frankly, usually sold to a buyer by Monday morning. Well, wait a minute. What happened here? The FDIC didn't even get involved with Signature until Sunday afternoon. That tells you something. Something odd happened there. There are allegations that illegal things happened there, and there were threats to sue over it. And boy, I sure hope that that people who were wronged in that situation, if indeed that's the case, do pursue their legal remedies in the judicial system, because that is the way for folks who are victims of agency overreach to have their rights restored.
Okay, wow. God, there's a lot to come on that then. Okay, let's finish on the end of QE to infinity. I fear, and this is something you and I discussed back in 2019 with Saifedean. We actually talked about what was going on. You said they're running out of bullets. I fear now there is a yo-yoing towards very high inflation. Now, it seems like I spoke to Lynn Alden. She said inflation is going to be the big topic of the next decade. They've tried to reduce inflation, and what we've seen is failed. And so now we're seeing liquidity coming back, which may drive inflation again. Are we potentially yo-yoing towards I don't want to say hyperinflation, but very high inflation?
Well, look, yes, because the system stability is so low, as we just witnessed, right? I mean, last week you had Jay Powell testifying before both the House and the Senate in the United States, and he said the system is stable. And then 2 days later, all of a sudden, the worst bank run in the United States, right? And the guy who was minding the store, the vice chair for supervision, was saying Federal Reserve supervised banks don't have bank runs, as the biggest bank run in 110 years was happening. So that, I mean, those things speak for themselves. Res ipsa loquitur, those things speak for themselves. So that tells you something. They didn't see it coming. And so what's the impact? I would encourage folks who are interested in the historical context to go read the book When Money Dies by Adam Ferguson. He's a British historian who wrote that book in the 1970s about the hyperinflations in Germany and Hungary. And what you learn as you read that book is that the amplitude of the crises increases and the frequency of the crises increase as the money is dying. Okay, we know the financial system, the traditional financial system, is inherently unstable. By the way, we've known that for decades. That doesn't mean that it collapses tomorrow. It could, but it could also still go for decades. So I've been critical of the economists who have been sort of, the broken clock economists that dollar's going to crash. They've been saying that since Nixon closed the gold window in 1971, and they've been wrong. The more interesting question is, why have they been so wrong? Because I do believe they will ultimately be right. And the answer is that the U.S. has had the balance sheet to keep doing what we've been doing. We will ultimately hit a wall, in which case they will be right. I just don't know when. It feels like it's likely to be during our lifetimes. And so that's why, plan accordingly. Look, Bitcoin's up 30% since this bank run started on Thursday. And I'm sure, those that wanted to kill it are mad as hell that Bitcoin's up 30% in their face. But needless to say, it's the system is fundamentally unstable. And you and I've talked about this before. Bitcoin's price is volatile, but the system is stable, very stable. The US dollar may not be volatile, but the system inherently is unstable. And I'll close with a Nassim Taleb argument that basically, if you constantly put out forest fires, when the conflagration finally comes, it burns the whole thing. And it might burn so hot that it kills the bacteria in the soil, and it'll take decades for the forest to reforest itself. And that's what I worry about, that by basically saying the U.S. can't have a recession because the Fed will constantly ease into that, all we're doing is drawing down that remaining balance sheet capacity to support the additional debt that is being issued. And there will come a day when the balance sheet is the only thing that matters. And right now, the Keynesians and the modern monetary theorists are in control of economic policy, and they don't think the balance sheet matters. And I think the balance sheet is the only thing that matters when it comes to that point. We just don't know when it is.